macro outlook is for slowing global growth, tightening monetary conditions, and there's also several risks out there, including a possible trade war and various political risks in Europe. So given that backdrop, we've seen more volatility in markets. Up until recently, market valuations, equities and credit markets have priced in a benign economic outlook and easy monetary policy. So it's not surprising we've seen this volatility. Now we expect that volatility to continue, so whilst valuations have improved given recent market falls, we still see there being increased risks. So we're fairly cautious on the outlook for equities and credit markets. So we still view emerging market local currency bonds as the most attractive of the larger and most liquid asset classes. And that's given the attractive yields we see, relatively inexpensive currency valuations, and decent underlying economic fundamentals. We're also pleased with the relative resilience of the asset class over the last year, and in particular in the last quarter when emerging market bonds actually produced positive returns as equity markets fell. Elsewhere, we see asset classes such as infrastructure providing a lot of interest, where you get good, reliable long-term returns both from renewable assets such as wind and solar, but also from social infrastructure, so essential parts of government infrastructure such as schools, hospitals, and that reliability return is really key in the current environment, we think. And finally, there's a range of interesting niche opportunities in things like litigation finance, healthcare royalties, asset-backed securities that we think offer attractive returns and add to the diversification within the portfolio.